Okay, it's recording.
Hi, I'm Bob Powell of Marketwatch, and I'm here today with Stuart Ritter, who is Senior Financial Planner at T Rowe Price. Stuart, welcome.
Thank you.
So, a couple things. Right now, one of the issues that we have in the United States with regard to retirement is that we have a crisis. And some might say that it's a crisis with respect to coverage, that only 50% of Americans, working Americans, have a retirement plan at work. So, is that one of the big problems that we face here?
I think it is in terms of how people think about retirement. It's too often linked to what my employer is doing. And what every single person needs to be understanding is at some point they will want to retire, which means people need to be saving for their own retirement, regardless of whether or not they have an employer, regardless of whether or not the employer offers a retirement plan. Everybody needs to be saving 15% of their salary. That's the number to remember, 15%. So if you're self-employed, if you're working for a large employer, a small employer, you have some other, you're staying home, 15% of the household income needs to get put away for retirement, whether it's an employer-sponsored plan or not.
So some people have trouble saving on their own. Would you be in favor of the automatic IRA plans that people have talked about?
Well, I think one of the things that we found when we look at automated services inside of 401k plans is those kinds of automated services are very successful at helping people save and save more. So if your employer offers a 401k plan, they might automatically enroll you. They might automatically increase the amount that you're saving. So some of the research and experience we've had shows that automated services help people save more.
Okay. So one of the things that is hard for people in retirement planning is to plan for how long they'll live. I think that's among the harder things.
Right.
So what's your advice around how people should handle that issue of life expectancy and longevity?
The first thing to recognize is probably the biggest risk that people underestimate when it comes to retirement planning is longevity risk. People are very focused on what the stock market did last week. They're very focused on what their next pay raise might or might not be. The biggest thing that a lot of people run into that might sabotage their ability to have the lifestyle they want throughout their entire retirement is the fact that people live potentially a very long time now compared to our parents or our grandparents. So we advocate folks planning out to age 95. Society of Actuary data shows that there's a good chance that people will live to that age. So it's not the average, because half the time you'll live beyond that. Plan to age 95. So that means saving 15% when you're saving. It means spending 4%, no more, the first year when you retire. Those are the kinds of things that you can do to help mitigate that longevity risk, since it's a big one out there and one that too many people underestimate.
And the trade-off is, if you were to die too soon, you'd leave a pile of money to your loved ones, presumably. But if you live too long, you'd live in, abject poverty.
Yes, that's what people need to recognize is the thing. People, of course, we all want it right now, and if I die too soon, I missed out on something. Yes, you may have missed out on a trip to the grandkids, but if you hit age 80, 85, and you run out of money, and 1 out of 5 people over the age of 65 right now have Social Security as their only source of income, that has an extreme effect on your lifestyle. And you want to make sure that you're saving enough when you're saving and spending a low enough amount that you're mitigating that risk.
All right, so one of the products that people often talk about with regard to longevity risk and outliving your assets is this notion of longevity insurance as a way, I like to describe it as a way of identifying your date of death. What's your take on the use of longevity insurance in retirement planning?
I think managing the longevity risk is something that's getting a lot of people's attention now and getting more information out there. So looking at different ways of managing that, whether it's how much you're spending, how you're investing your money, all of those things can help people do a better job of this now longevity risk that folks didn't have to think about as much before.
All right. One last question, if I could. There was a Frontline show. It talked about 401ks fees being excessive. What's your take on whether 401k fees are excessive or not?
I think what's even more important than that issue is how much people are saving. The biggest driver of your ability to have enough money to maintain your lifestyle in retirement is how much you save. It's totally within your control. You know exactly how much it is, and people should be focusing on that. There are lots of other things that affect readiness for retirement, and it's a lot of things that people need to be focusing on. The one I'm hoping they're starting with is, am I saving that 15%? Because that's the biggest thing within your control that you can put yourself on track.
So is it possible that investor mistakes cost them more than 401k fees?
And there are a lot of things that affect what the results are. I'm going to keep coming back to that one thing because not enough people are saving enough. It's saving 3% for retirement is like going to the gym for 6 minutes. So we can have conversations about cardio versus weight bearing and which way I do my bicep curls, but until I'm in the gym for a long enough period of time, it's premature to talk about those things. So get the savings rate to 15%.
All right. Stuart, thanks for being on the show.
Thanks for having me.
We've been with Stuart Ritter from T Rowe Price. My name is Bob Powell of Marketwatch. Thanks for watching.